Felix here, and my chief financial analyst just asked me, Felix, when do you sell? When do you really freak out? When is the market at a point where we should just throw in the towel and sell it all? This is Tallulah, my chief financial analyst. Just all the hard thinking around here. So if you thought this was financial advice, you're taking advice from a cat. Now, question really is, we're going to answer that here, is when to sell. To give you the maximum value, I'm also going to give you a free guide that I've written that really explains the whole concept with everything you just set up to follow along at felixfriends.org/crash. Thought that sounded optimistic. So download that, felixfriends.org/crash. It's completely free of charge. Now, what do we do to do this? Well, the first thing is we grab ourselves a nice looking stock chart here at tradingview.com, completely free of charge. And you then click on the indicator and you type in the letters S, M, and A. And it'll give you simple moving averages. And you'll click on that. And now it's putting 3 lines in here. And you're thinking, oh, that looks a little bit complicated, doesn't it? And click on the settings. Disable the 50 and the 100. We're only looking at the 200-day moving average here, which is exactly what it says on the tin. If you were to smooth out the stock movements over 200 days, that's what you'd get. So what does a crash look like? Well, let's look at COVID. I think most of us still remember that. So that's a good example here. And what happened? Well, what happened is that, let me get a pen so I can illustrate the point. We went down quite a lot. We crossed the 200-day moving average line, and that's when we really started to tank. So a good rule of thumb would be, well, just sell when you're crossing the 200-day moving average line because nothing good ever happens below it. That's an old sort of, banker's wives' tale, if you will. And there's definitely some truth in that. You've sort of sold here, you would have been feeling much, much better than everybody else. You would have been very, very smug at the bottom of the market. Now, is this a good idea? Well, it's a good idea, possibly, if you are in retirement mode, as in you have no income whatsoever, you're not buying stocks again, and you're just thinking, I need to protect what I've got, so let me exit here. But it also brings the question of, well, when are you going to enter again, right? Because presumably you want to continue to get a return from your money, and therefore at some point you're going to have to buy back in. When do you buy back in? Well, you could once again use the 200-day moving average line, and that would have gotten you out. So you got out here, you get in here, and you would have not participated in the general freak out that was pretty significant, like $1,000 drop in the S&P. But did you gain much? Well, really, no, right? You didn't actually. Okay, draw a straight line, maybe a slight benefit, but not a lot. So let's flip your mindset here for a second. The only thing in the world that people are upset about when prices fall are stocks. When you go to Costco and you see something you've always wanted to buy and it's on sale, do you run around and go, it's a crash, prices are crashing, panic? No, you go and you probably buy a little bit more than you normally would because you think, brilliant, I get more of what I wanted at a lower price. So if you have an income, I strongly suggest you use these crashes as a buy opportunity. Now, it doesn't feel good, but it is actually the best place to buy. And how do you do that? Well, the smart thing, in my opinion, is exactly to put the 200-day moving average line on here. So that's the one we got there, 200-day moving average line. And when you are below it, you buy a little bit more. And when you're above it, you buy a little bit less. Now, you could simply say, I'm going to invest, say, $1,000 a month. And that'll already kind of take care of it because you're getting more shares down here and you're getting less shares at the top, just because you have a fixed amount you're investing. But you could also get a little bit more creative about it, right? You could say, well, I'm only going to invest, I've still got my $1,000 budget. I'm only going to invest, say, $500 above, and I'm going to put the other $500 into some sort of interest-bearing account, which actually works right now, right? You can get some pretty decent interest, at least from some of the new banks right now. And then when the market does collapse below the 200-day moving average line, that's when I don't, and in those months, I then buy 500 plus the 1,000 that I was going to put in anyway, or whatever the balance is that you set aside. And therefore, you can buy at $1,500 worth of cheaper stocks down here. And historically, that's actually worked out really, really, really well. And I'll run you through in the guide, which you can get your hands on at felixfranz.org/crash, some examples of that. But even if we just zoom out a little bit here, if we may, are we allowed? I think we are. If you look at a long-term stock chart of the S&P here, and you just highlight the bits where we were below the 200-day moving average line here. Let's highlight that in green. Here and here, this was the 2018 crash, COVID crash. We then had the sell-off after the post-COVID crash, sort of 2022. We had a little bit of a blip in October. If you were just nibbling harder, buying the frickin' dip harder on those levels than above, you would collect more shares. Very, very simple, right? But would I stop buying? No, I wouldn't. Would I sell everything? Personally, no, because I've got lots of income streams. And ultimately, I think that's the important thing to get, is build more income streams, even if you're retired. One way you can do that if you want to learn how to trade. I've got lots of videos out on it, or just join my Tuesday live trading training at felixfranz.org/webinar. You're, of course, also super welcome to do that. And even if that isn't for you, it'll eliminate the choice, and you will then be able to look for another way to get some extra income in without having to put in a lot of hours. But historically, there are not many opportunities to buy stocks cheaper. And if your horizon is 5-10 years plus, those are actually glorious opportunities. So that's my wisdom here. Don't frickin' sell. Learn to get into a mindset where you're thinking, this is brilliant. Stocks are falling. I'm going to deploy more assets. And it might be a smart idea to set some cash aside for that. It could just be 10% of what you're investing every month, because then psychologically, you're going to go below that 200-day moving average line and you're going to be like, brilliant, we can deploy the extra funds. This is going to feel good. And it'll just deal with the monkeys in our heads a little bit better. So that's one of the things that I do. I'd encourage you to do something similar. Let me know what you make of this. Put your comments down below. And if you found some value in this, then please share the video. I'd love it. And I hope to see you on the next one. Winston and Felix here. And Winston just said to me, Felix, it's almost April. What stocks are we buying in April? And I thought, Winston, that's a genius idea.